Thank you so much for joining. In this video, I will give you a very short introduction to Goodwill. Goodwill is created when one company acquires another company. And then what usually happens is that the purchase price for the acquisition is allocated to all of the so-called identifiable assets, tangible and intangible, and liabilities that you acquire based on fair value. What is fair value? Fair value is usually defined as a price that would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants. So it's basically the value that you would think one asset, one machine, or even some liabilities have. There are different ways of determining fair value of an asset. We don't go into detail here. There's a market approach, there's a cost model approach, and there is a reevaluation approach. In general, when we talk about fair value, it's, from a Goodwill perspective, it's the value of assets and liabilities. Why assets and liabilities? Because when you buy a company, you basically buy the entire company. So you buy the entire asset base, but you also buy all the debt the company has. And then you need to refinance the debt, settle the debt or whatever, but you buy everything. So when you acquire the company, the purchase price that you pay is allocated to everything you receive in exchange. If, however, the purchase price is greater than what you bought, greater than the fair value of all the assets and liabilities, then the excess amount is recognized and called goodwill. So goodwill equals purchase price of the company minus fair value of identifiable assets and liabilities, sometimes called net identifiable assets. Question: why should I pay more than what I get? Why should I pay more than the fair value of the assets and liabilities that I receive in exchange? First, when you buy a company, the company has some value that is not recorded on the balance sheet. For example, if the company has a strong brand, established customer base, or trained employees, there's no balance sheet entrance for this, but this has still a value. So there is reputation and some intangibles that are actually not recorded on the balance sheet. Second, from an accounting perspective, this company that you just bought may have some research and development expenditures or marketing efforts that have not been capitalized, that can, however, create future value. So there's a reason for you to pay a bit more. And then the last, and especially in M&A, one of the key reasons is acquirers often pay for strategic benefits such as cost savings, increased market share, new capabilities, and we call it synergies. In general, goodwill is an asset, so it's recorded on the asset side of a balance sheet, and goodwill is not amortized, but it's tested for impairment annually. I will make another video on impairment, so it doesn't amortize, it will be impairment, and then you either have an impairment loss that you charge against the income in the current period. That's all. In general, what steps do you need to do? There are 3 steps. The first step is determine, step number 1, determine purchase price. And this includes all what you pay in stock, in cash, and other forms of consideration. So whatever your purchase price to acquire the other company is. Step number 2 is then to measure the fair value of identifiable assets and liabilities. And this is what you then call difference between assets and liabilities are the net identifiable assets. And then step number 3 would be calculate goodwill based on the formula above. Yeah, let's go through a very quick example. Let's assume company A buys company B for 5 million. Then you go look into company B and you realize or you calculate that the net identifiable assets are valued at 4 million. Then you would recognize goodwill of 1 million on your balance sheet. Yeah. Under both IFRS and US GAAP, goodwill is capitalized on the balance sheet and tested for impairment. And if goodwill is deemed impaired, then impairment loss is charged to the income statement, reducing net income and also total assets. Yeah, so goodwill in general reflects the premium paid for the company. When you look and compare different companies and you want to see whether one company has undertaken a lot of transactions, a lot of deals, goodwill is a good indicator to see whether many transactions have taken place. And then you can get an idea using the formula. I go into more detail on the accounting treatment and especially how to do impairment testing for goodwill in another video. But I hope you found this useful. Thanks so much for listening. Bye bye.